Hello everyone. Firstly, I hope each one of you is absolutely safe and secure in your respective regions, in your houses, in your offices. As we end the year, there is a light of optimism and hope that there will be a vaccine which will probably bring an end to our woes starting next year. On that happy note, a quick update on the monetary policy decision. We did see a status quo at the RBI monetary policy decision, which was announced. While the action or the inaction, I would say, was not so much of a surprise, I think there was a lot of anxiety in the market participants with respect to not so much the rate measures, but actually the liquidity measures. As we speak, the system is in the surplus liquidity zone, which it has always been almost since the start of the year, and specifically with the COVID-19 impacting the world economies across. And therefore, India has not been an exception. However, there was this growing whisper and murmur among market participants that there could be some premature withdrawal of this liquidity surplus in the system. Our thoughts on this: while it is okay to withdraw some amount of liquidity, there is a game plan for the CRR cut reversal in the month of March in 2021. There is also the LTRO payment or payback which is happening to the Reserve Bank of India from the banking system, which also leads to some liquidity exodus. And there is, of course, OMOs and Operation Twist are, Operation Twist is liquidity neutral, and OMOs right now have been injecting liquidity. Over and above this, the Reserve Bank of India has also been buying dollars, not so much in the very near past. However, they have been buying dollars, which also has been adding to the rupee liquidity. And last but not the least, there has been a voracious inflow of foreign portfolio investor money into equities, more specifically in the month of November. And while December has just started, the flows continue to be net positive. So I think all these were definitely, huge concerns, and there was a lot of conjecture on what would be the way forward. But I think the Reserve Bank of India, by sticking to its status quo stance, by maintaining an accommodative bias and not jumping the gun on liquidity so far, has indicated that we are in for a long pause. Yes, they have upped their guidance on inflation and bettered the outlook on growth. This was largely in line with our expectation. However, they also observed that household inflation on a forward-looking basis does not seem to be as ominous. So I think markets definitely have had a pleasant surprise. As they say, no news is good news. So something like this definitely has aided the sentiment of the bond markets. While we had seen some inching up of the bond yields in anticipation of a move, some bit of cooling off, therefore, was but natural. We have seen about 5 to 10 basis points lowering yield across segments, more specifically at the very short end of the yield curve, which is the most vulnerable both to liquidity infusion and liquidity exit. We also observe that the current shape of the yield curve is exceedingly steep, and clearly believe there is a case to make way for a flattener trade, probably over a series of time. It may not be abrupt, it may not be immediate. However, looking at the long pause and the accommodative bias, there has been a reiteration that accommodative bias will be for this financial year and also to flow into the next financial year, leads us to believe that carry over capital gain could be the most preferred trade for the bond markets going forward. We believe there is a very strong case to stay invested, as liquidity in the system would continue to anchor the bond yields with a marginal easing bias. There could be volatility along the way, no doubt, Markets could react to multiple data points. Recent data points on the macro front have been fairly mixed, not only in India but world over. So, on an incremental basis, markets would look forward to cues on the global front, and of course, look out for cues on the domestic front to take its next move forward. The ranges for yields broadly are going to be in a very tight range, and there is a reasonable chance that these ranges would start inching lower. We don't have anything substantive in terms of incremental expectations for the next policy, which is in February 2021, and in all likelihood by then we would have the budget out of the way. So it would be a reasonably action-packed innings as we get into the next policy, but till then looks like carry trade is likely to prevail. We would suggest investors to stay put across the fixed income strategies and not really rush to the exit window purely because the liquidity and the accommodative bias as a stance are potent tools to keep the bond yields anchored at the current levels. On that note, stay safe, stay invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.